There are many trading education resources out there. Some are free, and some cost thousands of dollars. In this video, I'm going to share with you some of the most common trading methods that these trading courses teach, in order to save you from wasting time and money from signing up with these overpriced courses. Trading and investing has been around since the dawn of time. Ever since civilization began trading goods, there have always been a market in place where buyers and sellers interact. The first documented stock market was created in Amsterdam, when the Dutch East India Company became the first publicly traded company. Ever since then, trading has evolved from calling your suit-wearing broker at the exchange, to having the convenience to place trades off your phone. With this long history, many trading strategies and analysis methods have sprung up. There are some traders who do nothing but watch news and react to how price react to it. Some traders simply buy breakouts or breakdowns of price and follow the trends. And some traders would implement the most complex set of algorithms to analyze every piece of chart data to make a trade. But, with all these different trading methods available, there are some basic fundamental trading approaches that will forever stand the test of time. These basic trading approaches that I'm about to share with you have been tested and used since trading charts have been invented. These are also the same trading methods that some of these paid trading education have always included in their curriculum. Hopefully you can begin your own research into these methods without spending a dime in paid courses. The first very common trading method is trading off support and resistance, or in fancy words, supply and demand lines. Trading educators love to teach this trading method. Essentially, it is about drawing up horizontal zones on your chart that encapsulates the price action. No matter what time frame you look at, you can always use this analysis to show where price has been and where the reaction areas are. The basic trading approach with this analysis is buying at support, and of course, selling at resistance. The idea is that price tend to have memory due to the participants in the market. They usually remember significant turning points, especially around round numbers. Traders' orders around these past turning points in price is what creates the reaction around these support and resistance zones. Some strategies will include an overbought-oversold indicators to confirm these drawn-up levels. So do these analyses really work? Well, there's a reason they teach rather than trade, right? The next method is a continuation of the support and resistance analysis, the almighty Trendlines. Trendlines takes the support and resistance analysis further by incorporating natural trends that price tend to exhibit during bull or bear markets. What Trendlines does is to show traders potential entry and exits within the trend. A channel pattern is probably one of the most common patterns in the trendline analysis. In addition, some traders will also include the popular Fibonacci lines. Essentially, the Fibonacci lines would break the trend lines into significant zones based off the Fibonacci percentages. There have been a lot of studies that show price do react well around Fibonacci lines, especially the 38, 68, and 50% lines. Again, just like previous analysis with support and resistance, traders would add additional confirmation indicator like the overbought-oversold indicators, and also the common moving average indicator. And finally, you can't create a trading course without including the tried and true, the breakout trade. Breakouts are usually included in trading courses just because it's so simple to understand. You buy when price go up, and you sell when price go down. Of all the trading approaches, this is probably one of my favorites because it is very objective in nature. Some breakout trading approach will have you buy when it breaks a significant price channel. Some would argue that it's best to wait for a retest of that channel in order for the trader to get a better entry. Regardless of which method you use in breakouts, the outcome is still the same. You are trying to jump into a moving market. Some traders will include a confirmation indicator like high volume behind the break. Remember, overbought-oversold indicators are pretty much useless in breakout patterns since you are following the market, when the indicators are usually at the extreme levels. These trading methods I've shared with you are very popular topics in trading courses. The reason is because they do tend to work some of the time. Remember, there is no such thing as a no-fail method, so use these trading approaches with caution. It's important that if you choose to use any of these trading approaches, that you also include supporting indicators as confirmation. Things like overbought, oversold indicators, moving averages, and even volume are some common confirmation indicators. The main thing that will help in trading is not so much the trading method, but your risk management. Like I said, there is no such thing as a no-fail trading method, so your risk management needs to be on point in order to limit your losses. Anyway, I hope that you can take some information from this video to create your own trading method that is profitable. You can Google these methods online and further your understanding with free online resources. If you enjoy this type of trading content, or even learn about investing and personal finance in general, please support me and leave a like and subscribe to this channel. Later.